Hello, my name is Alfredo Perez, and today I'll be answering the questions over the valuation of FMS securities. So to start, we have what is the expected rate of return and its effective annual rate. So here we have two different formulas. The nominal expected rate of return is calculated by taking the par value times the cumulative dividend divided by the current price. So we have $100 times the 4.32% divided by $48, and from that we get 9%. So then we take that nominal expected rate of return and put it into the effective rate of return, which is seen right here calculated on this side, on this right side, and we get 9.31%. Next, we're asked if the nominal required rate of return is 8%, what is the current rate? What is the current January 1st, 2004 value per share? So here we take the remaining shares of $300,000 with a sinking fund of $6 million and total payments that vary on this side. With the nominal rate, we calculate the present values, and we get the sum of $31,352,000. Divide that by the $300,000 remaining shares, we come out to a share of value of $100.51. Entergy's corporation's expected rate of return at the beginning of 2003. If the dividends is $1.80 from the start of 2003. So the expected rate is the dividend yield plus the growth rate. So we take the next dividend divided by the current price plus the growth rate, and we see that we come out to 14.09%. What was the expected dividend yield and the expected capital gains yield on January 1st? So we take the expected dividend yield of the next dividend divided by the current price. We come out to 8.09%, and the expected dividends yield is the next price minus the current price divided by the current price. And you see here we get 6% for that. Question 3 asks, what conditions must hold to use the constant growth Gordon model? Do real-world stocks satisfy the constant growth assumptions? So here I have a list of requirements for firms to use the Gordon model. The expected rate of return is equal to the expected dividend yield plus the expected growth rate. The stock price is expected to grow at the same rate. The expected capital gains yield is also constant and is equal to the growth. The expected dividend yield is constant, and the dividend yield is expected to grow forever at a constant rate. There are many stocks that satisfy this. However, they are the very large companies that are allowed to get away with using the constant growth model. Question 4 asks, what was the value of Entergy's corporation stock on January 1st, 2003? If the required rate of return is 13.5%, remember this value as you calculate. It does not have to agree with the market value price of $22.26. So after calculating all the present values, we come to a price of $28.63 with this required rate of return of 13.5%. Question 5 asks, what is the expected stock price at the end of 2003, assuming the stock is in equilibrium, and also what is the expected stock price at the end of 2004? So we see that at the end of 2003, that the price is $32.72, located right here at the bottom, and the top one gives the price of $31.38. So question 6 asks, what is the expected dividend yield, capital gains yield, and total return for 2003? So here the expected dividend yield is calculated by the next dividend minus the current price. We come out to a 6% dividend yield. Capital gains yield of the next price minus the current price divided by the current price would come to 5.6%, and the total rate of return is those two calculated and added, to 12.43%. So question 7 asks, suppose Entergy's dividend rate is expected to remain constant at $1.80 for the next 5 years and grows at a constant rate of 6%. Required rate of return is 13.5%. How would Entergy's corporation stock be higher or lower than in problem 4? So here we see that with a constant dividend of $1.80, that we get to a present value of $19, which is less than the price that was listed in problem 4. So question 8 asks, if the stock price is $22.26 at the beginning of 2003, using the growth rates given in the introduction of this question, what is the expected rate of return for the stock? So with all the calculations here, we see that the total yield would be 43.71%. Question 9 is, based on the information provided in the value line tables, is the assumed 6% growth rate reasonable? What has been the trend? So compared to the dividends paid out, it suggests that 6% is too ambitious because the actual dividends grew from 3 to 4%, and 6% would not be feasible for this company to use in a model. So question 10 asks, could these figures be used to develop an estimated long run sustainable growth rate? And does the figure support the 7.5% growth rate given in the problem? So the figures would not be able to develop a long-term sustainable model because it's just not feasible for the company, and it would suggest that the 7.5% growth rate is too ambitious. Thank you.